In 2026, retirees under 65 face one of the biggest healthcare changes in years, the return of the so-called subsidy cliff, which could send your premiums skyrocketing by thousands of dollars per month. In this video, I'll explain what's changing, why it matters, and how to prepare so your retirement plan doesn't get derailed. Before we dive into the 2026 changes, let's make sure we're all on the same page about how the Affordable Care Act, or ACA, works. ACA is a public marketplace where most people under 65 buy their health insurance before Medicare kicks in. One of the key features of ACA plans is a subsidy, government support that will lower your monthly premium. The formula is quite simple. The lower your income, the bigger the subsidy. Since 2021, thanks to the Inflation Reduction Act, those subsidies have been much more generous. Even high-income retirees, sometimes earning $150,000 or more, could still qualify for some meaningful support, which made healthcare costs much more manageable. But starting in 2026, those expanded rules expire. We go back to the old system where subsidies cut off sharply once your income passes a certain threshold. That's what's called the so-called subsidy cliff. Go even a few dollars over that line and you now lose your subsidy entirely. On the screen, you'll see an example of just how dramatic this change can be. On the right-hand side of the screen, you'll see an example of just how dramatic this change can be. Take a retired couple with $100,000 of retirement income. Under today's rules, they would qualify for almost $1,500 a month in subsidies. That's $18,000 a year. Their cost for a silver plan, which is a mid-tier plan, would be around $700 per month. But in 2026, that same couple with the same income falls right off of that subsidy cliff. Their subsidy disappears overnight, and instead of paying $700 a month, their premiums jump to over $2,100 a month. That's $18,000 for the year that's completely gone in an instant, and it's one of the most important planning issues that retirees face today. So the big question is there a way to position yourself to still qualify for those subsidies under what will be the new rules? The answer is yes, but we'll get into that shortly. Now that we've seen how the cliff works, let's take a step back and talk about the plans themselves. When you buy through the ACA marketplace, you'll see different levels of plans: bronze, silver, gold, and platinum. Now, these levels don't change the doctors you can see, but they do change how costs are shared between you and the insurance company. A bronze plan will be the cheapest, but cover the least. Gold and platinum will be the most expensive, but will lead you to pay the least out of pocket. We will often quote a silver, middle-of-the-road plan in our examples. But here's the reality: ACA plans aren't cheap. As you just saw, unsubsidized insurance can cost north of $2,000 per month for a couple, and premiums have been steadily rising year after year. That's why these subsidies are so important. They don't just make healthcare affordable. For some, they actually determine whether an early retirement plan is even feasible at all. And that's exactly why the 2026 rule change matters so much. Now here's where planning gets a little bit tricky. ACA doesn't base your subsidy on the money you're actually living on in retirement. It's all about something called your reported income, technically called Healthcare Modified Adjusted Gross Income. Healthcare Maggie pulls in more than most retirees realize. It includes wages, IRA and 401k withdrawals, pension and annuity income, your full Social Security benefit, whether it's taxable or not, interest, dividends, and capital gains from investments, even unemployment benefits. And here's the kicker: unlike your tax return, you don't get to take the standard deduction out of this so-called reported income. This means your healthcare Maggie on paper will oftentimes be a lot higher than your taxable income. This is why I always tell retirees ACA subsidies aren't about what you spend, they're about what you show. And this can cut both ways. If you're sloppy, you could report far more income than you're really using and end up paying thousands more for healthcare. But also, if you're strategic, you can do the opposite. Spend a very comfortable income in retirement while reporting a much lower one and therefore earning quite large subsidies. And that's where the real planning opportunities get powerful within this discussion. One thing that's important to note on this slide: Roth withdrawals don't count towards reported income. This will lead to some very interesting strategies a little bit later on. So if the subsidy is based on your reported income, the next question is, how does the government actually decide who gets a subsidy? This comes down to something called the federal poverty level, or FPL. Every year, the government sets an income guideline based on your household size. Your healthcare Maggie is then compared as a percentage of that number. 400% of the federal poverty level is the most important figure here. Under the temporary 2021 to 2025 rules, there wasn't really a hard cutoff. Even if you were well above 400% of the federal poverty level, you could still qualify for some somewhat large subsidies. But starting in 2026, that extra flexibility disappears. Once you cross over that 400% level, the subsidy stops cold. That's why it's called the subsidy cliff. Now, for your situation, the 400% level will change based on your household size. A single retiree will be able to show less than a married retiree. The number also adjusts to inflation on an annual basis. But this is the level at which you fall off the cliff or stay under the cliff. In the opening slide, we looked at fairly high level how much this 2026 subsidy cliff change could cost. But again, that was fairly surface level. There are a few other important things to note here. On the screen, you'll see the same silver plan for a retired couple in Arizona. I've run two examples. One where they report $42,000 of income, comfortably below the cliff, and another where they report $90,000, which pushes them over that cliff. Now, most retirees think the only difference is the monthly premium. And yes, that alone is quite massive. In this case, premiums jump by more than $1,500 a month once you fall off the cliff. But here's the part many people miss. Your reported income also affects your out-of-pocket costs as well. With the higher income scenario, the deductible and out-of-pocket maximums are $2,000 higher, and pay-per-visit costs are slightly more as well. So when you add it all up, the premiums plus the higher cost sharing, you're looking at nearly $20,000 a year in extra expenses just because of how your income shows up on paper. That's why managing your reported income is one of the most important levers in retirement planning, especially early on. Now, in order to make strong decisions in planning around this important subsidy cliff, it's important to turn costs into a marginal tax rate. Marginal tax rate is just the cost you are paying for showing an additional step of income. For instance, if we're earning a subsidy and showing $1,000 extra of income, and that would mean our healthcare costs for the year rise by $85, then our marginal cost of that extra $1,000 would be 8.5% plus whatever we paid in taxes on that $1,000. I'll show an example later that will really highlight why marginal costs are so important to calculate. But on the screen, I am using the same silver plan that we just showed in the last slide. And I want to try to show the marginal cost of falling over the subsidy cliff. So let's say in 2025, we have the ability to show $80,000 in reported income if we fill in some of our spending from Roth accounts. Or if we took everything from traditional IRAs, our total spending would lead to $100,000 reported income. So we are asking the question, what is the marginal cost of just losing out on that subsidy here over this $20,000 range? In 2025, our premiums go from $6,600 per year to $8,500 per year. That's $1,800 in increases in premiums that lead to a 9.36% marginal rate if we're just looking at healthcare premium costs. This creates a low enough rate for some couples that they may choose to preserve Roth assets and simply show that higher income in 2025 and prior. In 2026, as we've already discussed, everything changes. Prior to the subsidy cliff, the system is slightly less forgiving. So at $80,000 of reported income, they would be paying about $7,200 per year. At $100,000, they would pay the full cost, $19,000 in premiums for the year. Now we see about a $12,000 increase in healthcare expenses, and our marginal rate transforms into nearly 60%. Again, why is this number important? Because at a 60% marginal rate, it becomes very obvious that a retiree will want to use Roth assets to stay below that subsidy cliff threshold. In fact, of all the uses one has for a Roth IRA, you'd be hard-pressed to find a better use for these dollars because this marginal rate is so high. So Roth dollars become crucial for early retirees wanting to earn a subsidy. But let's shift some gears here and talk about some tactics around earning a subsidy. Where I would start with every retiree is first figuring out what their base forced income amount will be. When I say forced income, I mean income that you can't really choose whether or not to take it. Think about pension or annuity income, Social Security benefits. If you have a sizable taxable account, dividends and interest will fit in here too. Just about everything else from here is a choice. We can choose which account to pull from to form our remaining spending or income needs. Assuming that your forced income isn't already above the subsidy cliff, there are two accounts that will be your quote unquote get out of jail free cards for taking a high income while reporting a lower income. Your taxable account and your Roth account. Your Roth account is pretty straightforward here. Withdrawals from this account are not counted towards that reported income number. So if your forced income is $40,000, you can take as much additional income to spend as you need from a Roth account, and your reported income would stay at $40,000. Your taxable account is an account that is partially counted. Just interest and capital gains are counted here. So let's say you are selling a bond or a bond fund within this account. Any interest that position generates counts against you dollar for dollar, but you will likely have no or at most a very small capital gain from selling those bonds. So you could have a $100,000 bond tranche set up in your taxable account specifically for ACA planning purposes. And if the interest on that bond is around $5,000, then you effectively have a position that unlocks $100,000 of spending for only a $5,000 added cost to your reported income, or rather, not added cost, but just adds into your reported income. If you are selling a stock or stock fund, the same general dynamics apply, but stocks don't have any interest. They have dividends instead. Capital gains will vary based on each position, but let's say that you have a stock worth $100,000 that has $70,000 cost basis. You could sell that stock, unlock $100,000 of spending, and only $30,000 would count towards your healthcare Maggie. The point here is between your Roth and your taxable account, strategic use of both can allow a retiree to spend well over six figures of income, but still report a very low income, thus earning those big subsidies. Now, one thing that is very important to mention, you will want to show some level of reported income in these ACA years. In most states, if you fall below 100% of the federal poverty level, you are generally directed towards Medicaid, which most retirees won't want. Medicaid severely limits choices in doctors and hospitals. This brings us to some important moves you may want to consider before retiring. If you're someone who already has a low forced income base, maybe you've got solid assets in taxable and Roth accounts to bridge the gap to Medicare, then great. You're in a really strong position and you probably don't need to do much to prepare for the subsidy cliff. But let's take another scenario. Imagine you're 63, planning to retire next year, and all of your assets are currently in traditional IRAs. For the last few years of work, you've been in the 24% tax bracket, earning a really good income. Now, normally, most advisors would say don't do Roth conversions while working at your current income level. They tell you to wait until retirement when your income in your tax bracket will be lower. The problem here, once you retire, you immediately hit that subsidy cliff with no way to keep your reported income low. Every dollar that you need to take from your traditional IRAs, and that dollar counts towards that reported income. This makes it very difficult to earn that subsidy. And remember, we've already seen that the marginal rate from falling off the cliff can grow to upwards of 60% when you include healthcare costs. Suddenly paying 24% now doesn't sound so bad. In fact, it looks quite smart, because if we're able to convert at 24% and get dollars into our Roth account that we can then use next year to show lower reported income and qualify for subsidies, we know that equation makes sense on our behalf. We're paying 24% to avoid some sky-high marginal rates that healthcare would force us into. So how much should we convert from here? Well, that depends on your spending needs. If this couple typically spends around $95,000 and we want their reported income closer to $80,000, then we only need modest Roth conversions to cover the gap for a few years. If their lifestyle is higher, we'll need more. The point is, Roth dollars are worth a premium in the context of healthcare planning before 65. Paying a decent tax rate now to create flexibility later is often the right move. Now let's look at a different retiree. This retiree might be coming off COBRA, or maybe they're retiring into ACA coverage, but instead of only IRA assets, they've got a large taxable account they're dealing with. Sounds great, except most of those positions have been held for a long time, and the cost basis is very low. This creates its own problem. If you sell $50,000 of stock with a basis of only $10,000, you'll report $40,000 of income. That doesn't really help much, and it's not all that different from pulling from an IRA. In this case, it may make sense to do some tax gain harvesting ahead of retirement or ahead of the switch to ACA. In plain terms, that means selling and immediately buying back the same position to reset your cost basis at today's higher value. Or you might want to sell and shift into a different investment like bonds if it fits your broader plan. Either way, the goal is to create flexibility here. Because when ACA subsidies are worth thousands per month in value, it's often worth paying some tax now to avoid much higher costs later. Now, before we wrap up, it's worth pointing out that there's been some discussion in Congress about this subsidy cliff. At this time, there's nothing concrete, but proposals do exist that would take an intermediate approach between the current rules and the subsidy cliff rules. As of today, nothing has officially changed. And the fact that this extension wasn't included in the most recent One Big Beautiful Bill leans towards a higher probability that these expanded subsidies really will expire after 2025. So yes, Congress could act, but as we get closer to year end and we see no changes, setting yourself up for the next year's situation becomes paramount. I would recommend mapping out strategies that you can use right now, but maybe wait until a little bit later in the year to initiate them. In general, plan based on the rules that we know today over the what ifs. I hope you found this video helpful in keeping healthcare costs low in retirement. If you want more content on how to improve your position in retirement, click the subscribe button down below. Always remember, you don't need more money, you need a better plan. I look forward to seeing you in the next video.